Gold just crossed $3,350 an ounce, up over 430% in 20 years. Sounds unbeatable, right? Here's the number nobody shows you. Over that exact same 20 years, gold still lost to a boring index fund by $17,000 on every $10,000 invested. And if you're in your 20s right now, the real gap is $416,800. Let me show you the math. Meet Maya. She's 28, makes $58,000 a year, and just crossed $10,000 in savings for the first time. Huge milestone. But now she's stuck. Every headline she opens says the same thing: gold at record highs, gold is the safe haven, central banks are buying gold. Her uncle at a family barbecue tells her, stocks are a casino. Gold is real. You can hold it. And honestly? That hits. Maya watched her parents panic in 2008. She's seen 2 market drops just since she started working. The idea of something that can't go to zero, something shiny and permanent, feels like the adult, responsible move. So she's about to put her entire $10,000 into gold and call it a day. This is one of the most common money crossroads for people building their first $10,000 to $100,000, the moment fear of losing money starts making decisions for you. And here's the thing, Maya's instinct isn't stupid. Gold really did jump massively over the past 2 years. But she's confusing 2 completely different jobs, protecting money and growing money. And mixing those up in your 20s is one of the most expensive mistakes you can make. Here's why. Think of it like this: gold is a fire extinguisher. A stock index fund is the actual house. You absolutely want a fire extinguisher, but nobody gets rich buying more fire extinguishers. Here's the mechanism. When you own a share of the S&P 500, you own a slice of 500 businesses that wake up every day and try to make money. Apple sells phones. Costco sells memberships. Those profits get reinvested or paid to you as dividends, and those dividends buy more shares, which pay more dividends. That's compounding, money making money. Gold can't do that. An ounce of gold in 2006 is the exact same ounce in 2026. It never earns a dollar, never pays a dividend, never invents anything. Its price only rises when someone else is scared enough to pay more for it. That's why gold's price moves in fierce spikes, 2008, 2020, and yes, the last 2 years, and then goes flat for a decade. If you'd bought gold at its 1980 peak of $850, you'd have earned roughly 3% a year for the next 46 years. Barely beating inflation. Businesses compound. Metal just sits there. That's the entire difference, and over decades it's not a small difference, it's the whole game. Now the objection: I know you're thinking, but what if the market crashes? Fair. Let's look at what actually happened. In 2008, the S&P 500 dropped 37%, brutal. Gold rose about 5% that year. So yes, gold did its fire extinguisher job. But here's the part the gold ads skip. Investors who just stayed in the S&P 500 recovered every penny by 2013, and then more than tripled their money over the following decade. The crash was temporary. The compounding was permanent. Over the full 20 years, crash included, $10,000 in the S&P 500 with dividends reinvested grew to roughly $70,000, about 10.2% a year. That same $10,000 in gold, even after gold's massive recent run to $3,350? About $53,000, 8.7% a year. Gold's best 20-year stretch in modern history, and it still finished $17,000 behind on a single $10,000 investment. Crashes are the price of admission, not a reason to hide. Let's run Maya's actual numbers. This is the part that matters. She has $10,000 today and can invest $200 a month for 30 years, until she's 58. Path 1, all in on gold. Gold's realistic long-run return is about 5% a year, remember, since its 1980 peak it's closer to 3%, so 5% is generous. Her $10,000 lump sum at 5% for 30 years, 10,000 times 1.05 to the 30th power equals $43,219. Her $200 a month at 5% grows to about $166,440. Total, roughly $209,700. Path 2, a plain S&P 500 index fund at its historical 10% average. The $10,000 lump sum, 10,000 times 1.10 to the 30th equals $174,494. The $200 a month compounds to about $452,000. Total, roughly $626,500. $626,500 versus $209,700. The difference is $416,800. Same person, same paycheck, same discipline, same 30 years. The only variable is whether her money owned businesses or owned a rock. And notice, the gold path isn't a disaster. $209,000 is fine. But fine cost her $416,000, which at a 4% withdrawal rate is about $16,600 a year of retirement income, every year, forever. That's the invisible bill for feeling safe. Here's your one action step, and it takes 4 minutes. Go to Fidelity.com, open a Roth IRA, it's free, no minimum. Search FXAIX, Fidelity's S&P 500 Index Fund, and buy $50 worth. Then hit Automatic Investments and set $200 a month, or whatever your number is, for the first of every month. Done. And if gold still helps you sleep at night? Totally fine, buy the ticker GLDM and cap it at 5% of your portfolio. That's the fire extinguisher. The other 95% builds the house. Do it today, because as we just calculated, every year you wait on compounding is the most expensive year of the whole journey. Subscribe for one money idea every single day, no fluff, just the real math. And drop your money question in the comments. I read every one. See you tomorrow.